Good morning, this is Jeff Hildebrand for TBL Traders. Today's video will be on futures specific risk. Why are we going to talk about this? Futures, if you're not used to trading them or if you aren't very experienced trading them, carry with them a collection of specific risks. They are a dangerous product to trade. Start slowly. First of all, margin. I've spoke about that in another video. Be aware that every futures product carries different types of margins and margin requirements. Here, in this case, is gold. If you look at oil, you'll see that it's a slightly lower initial margin. If you look at bonds, do I have a bond up here? Yes, bonds. You'll see even lower margin requirements. So as you look at futures, be aware that the margin requirements are different. There is one thing that's true across futures. You have unlimited liability for a futures contract. It is possible to lose more than the committed capital, which is not the same as buying an option, for example. You buy a put or buy a call, you will lose the value of your purchase price on the put or call. That comes with an asterisk. You can also be short puts and calls, and in that case they look more like a futures contract where you have a lot more liability if you're naked options. But in any case, the basic idea is your futures contract has unlimited liability. It's not exactly the same with options trading. Be very, very careful of leverage and position size. Know the product multiples and the nominal risk associated with those. When I showed you oil, know that it's a multiplier of 1,000. When I showed you the ES, know that it's a multiplier of 50, and be aware of the nominal value of those contracts. You've seen that in other spreadsheets that I've shown you before. That is effectively your risk. It's the nominal risk associated with those contracts. If for some reason you are unable to get out of a trade, unable to get out of a futures contract, or you don't have enough experience to be neutral or hedge those future contracts, there is a specific risk with futures contracts. I can't say it enough. The other thing is daily settlement. Losses are accounted for on daily basis usually. If you trade within a reasonable risk band and you understand your risk, this doesn't usually come into play, because you won't put too much capital on the line. If you have a smaller trading account, just be aware that it's daily settlement, and whipsaws and whiplashes across the pricing of a particular contract can take you out of the game, basically. And having said that, be aware of the products you're trading if you're a beginner. Don't jump into trading grains if you've never traded futures. Start with index futures. There's this particular risk, policy and market risk, I call it, agricultural subventions, for example, government intervention within the metals markets, for example, natural disasters. Those can have unexpected effects on your futures contracts, leading to something that happens every few years. I haven't personally run into it yet, but it's called limit up and limit down. This was put in place by the markets to manage the maximum amount of risk. Well, sorry, not the maximum amount of risk, but the maximum amount of which a futures price can move during the trading day. They did this to try to avoid extreme volatility in the futures markets. Any book I've read quite a few very successful traders have at one time in their life run up against the situation where they were in a limit up or limit down situation and couldn't get out of a trade. This, combined with unlimited liability, is a dangerous combination and can basically bankrupt you. So be very cautious of trading futures. Those are some of the examples that I have. I don't have a lot to show you today, except to be aware of, as I've said before, the expiration. Be aware of the multiplier. be aware of the nominal value. Let me show you the nominal value, what I mean by that. Hold on. Okay, when I speak about nominal value, speaking about this table that I use personally. For example, let's take the E-mini S&P 500. One contract has a nominal value of $97,000 at 1949. You've seen how I use these calculations. If it goes up to 2,000, the nominal value is 100,000. If it goes down, let's take this down. These prices aren't exactly right. These are prices a little older. It goes down to 1900. If this price goes down to 1900, for example, I have a nominal value of 95,000. Okay, so if my margin account, if I have a very small trading account, and I have a daily settlement, and I have a profit loss $2,400 on one day, you can see what's going on here with my margin, and I'm apt to get taken out of a trade that I don't necessarily want to be taken out of. So that's what I mean by be aware of the nominal value of your contract. Be aware, be able to relate the profit and loss to your account size and your risk and the risk you associate. As I've said before, I would never want to be in my total account. I don't take more than 2% risk. Just that move here, it's a big move obviously, but it's 2.5%, so that surpasses my risk limit unless I have managed to put on a hedge. So futures contracts are a little more complicated. Know about them, know the risks associated with them, and I think that's about it for this quick futures specific risk video. Let me know if you have any questions. Thanks a lot.